Welcome back to the Deep Dive. This is where we take on those really dense professional requirements, the tough academic stuff, and we try to turn it into knowledge you can actually use, knowledge you need to hit that next career milestone. And today, we're tackling a big one. We're diving deep into the ACCA Audit and Assurance exam, the AA paper. Our aim is to give you the structure, connect the dots, and show you the practical application needed to really get to grips with this huge syllabus.
Exactly. This is all about transforming that, let's face it, pretty dense syllabus and study guide into a focused strategy for your exam prep. If you're sitting AA, you know the sheer volume is daunting. Regulation, risk, evidence, controls, reporting. It's a lot.
It really is.
So our goal isn't just defining terms. It's about showing how they link together. Because, those links are exactly what Section B, those big scenario questions, are testing. We need to think like auditors facing real problems.
Absolutely. Think of this as your structured path, maybe even a shortcut through the syllabus. Now, before we get into the core stuff, let's cover the essentials, the resources. The source material is crystal clear on this. Question practice isn't just recommended, it's described as vital.
Cannot stress that enough. Seriously.
Yeah.
Knowing the theory might get you through Section A, the objective tests. But Section B, that's 70% of the marks. You have to practice applying the knowledge in those written scenarios.
Yeah. So what do you recommend?
Well, definitely use the free open tuition resources. Their lectures are great. The online tests, flashcards for key terms, very helpful. But, and this is crucial, you must combine that with a proper, up-to-date question bank. Something like the BPP revision and exam kit is essential.
Okay, good advice. And that focus on application is why we're structuring today's deep dive the way we are. Remember the exam format. 3 hours, computer-based.
Yeah.
Section A, 30% of marks, 3 case questions. Could be anything from the syllabus. But Section B, that's the heavy lifting, 70%. And it mainly targets syllabus areas B, C, and D. That's planning and risk assessment, internal controls, and audit evidence. These are the areas where you need to show you can analyze, recommend, respond.
And that's precisely where I'll be spending most of our time today, building that practical understanding.
Right then. Let's jump in. Part 1, the regulatory core. Okay, starting at the beginning, Chapter 1 stuff. The nature of assurance and audit. Why do we even have this concept of assurance?
Well, it really boils down to reliance. Think about it. As a user, maybe a shareholder, you often don't have the skill or the time, or maybe you're just not physically there to check if something like the financial statements is accurate.
Right, you have to rely on what management tells you.
Exactly. And when you rely on information someone else provides, you need 2 things. Some agreed upon standards or criteria to measure against, and crucially, an independent check on whether those standards have been met. That whole process, enhancing confidence in information, that's assurance.
And the statutory audit, that's the most common, maybe the highest level of assurance we deal with.
Yes, absolutely. The definition laid out is critical. The independent examination of and expression of opinion on the financial statements, 2 words there are just fundamental.
Let me guess. Independent and opinion.
You got it. Independent is the cornerstone. If the auditor isn't truly independent, the whole exercise is pointless. The opinion has no credibility. Integrity is gone.
And opinion.
That's key too. We're not certifying facts. We're not issuing a guarantee that everything is 100% correct down to the last cent. We're providing a professional judgment, a conclusion based on evidence. Do the statements present fairly, or do they not?
Okay, so because it's an opinion, based on judgment and evidence, not certainty, that leads to the concept of reasonable assurance.
Precisely. We provide reasonable assurance. That's a high level of confidence, but it's not absolute assurance. And you absolutely need to understand why we can never give absolute assurance.
What are the main reasons? The inherent limitations.
There are several. First, financial statements contain subjective judgments. Think about provisions, depreciation, asset valuations. These involve estimates. They can't be perfectly verified.
Right, there's inherent uncertainty.
Then there's the practical reality. Audits have to be done within a reasonable time and cost. That means we use sampling, we don't check every single transaction, it's just not feasible.
Sampling risk.
Exactly. And the big one, the possibility of fraud, especially collusion or sophisticated schemes designed specifically to hide things from the auditor. We design tests to detect material misstatement, whether from error or fraud, but we can't guarantee finding everything, especially well-concealed fraud.
So reasonable assurance acknowledges those limitations, high confidence, but not certainty. Okay, let's unpack the 5 elements that define any assurance engagement. This is basic, but crucial.
Absolutely fundamental. First, you need a 3-party relationship. You've got the practitioner, that's the auditor doing the work, the responsible party, usually management, who prepared the information, and the intended users, the shareholders, the bank, whoever the report is for.
Okay, practitioner, responsible party, users, got it. Second.
The subject matter, what's being examined. In AA, overwhelmingly, it's the financial statements.
Third, suitable criteria. What are we measuring the subject matter against?
Yeah, the benchmark. It has to be suitable, relevant, complete, reliable, neutral, understandable. For financial statements, that's usually IFRS or local GAAP. Without suitable criteria, the opinion's meaningless. It'd be like measuring length without a ruler.
Makes sense. Fourth element, this links directly to our procedures later, sufficient appropriate evidence.
This is huge. Sufficient refers to the quantity, have we gathered enough evidence. Appropriate refers to the quality, is the evidence relevant and, crucially, reliable.
And there's a hierarchy of reliability, isn't there? You need to know this for justifying your procedures.
Definitely. Memorize this. Evidence from external sources, like a bank confirmation, is generally way more reliable than evidence generated purely internally by the client.
Yeah.
Evidence obtained directly by the auditor, like physically observing inventory count, beats evidence simply handed over by the client. Written evidence trumps oral evidence every time. And originals are better than photocopies, though that's a bit fuzzier with digital records.
So let's take an example. The client's finance director tells you verbally there's no major litigation pending. Why is that less reliable than getting a written confirmation directly from the company's external lawyers?
Several reasons, straight from the hierarchy. It's oral versus written. It's internal versus external. The finance director, the responsible party, might have biases or pressure not to disclose. The external lawyer is independent, subject to their own professional standards, and providing written confirmation directly to us. Much higher reliability.
Got it. And the fifth element?
The written assurance report. This contains the practitioner's conclusion, and the wording here depends on the level of assurance being provided.
Right. Positive versus negative assurance.
Exactly. For a statutory audit, we give reasonable assurance, that positive statement. In our opinion, the financial statements present fairly. For something like a review engagement, we only give limited assurance, which is negative. Nothing has come to our attention that causes us to believe. See the difference. Much more guarded. Less confidence conveyed. #tag corporate governance and the auditor.
Okay, let's shift gear to Chapter 2, Corporate Governance. It's not just about knowing the rules, it's understanding how the auditor fits into that framework.
Yeah, it all stems from the agency problem. You have directors, the agents running the company, shareholders, the principals, own it, but the directors might act in their own self-interest, bigger bonuses, job security, whatever, rather than purely for the shareholders.
So governance is the system to try and align those interests.
Exactly. The system by which companies are directed and controlled. That's the classic definition. And the audit plays a key role because the financial statements are the primary way shareholders measure the director's performance. Our independent opinion adds credibility to that measure.
And the framework we focus on is the UK Corporate Governance Code, famous for its comply or explain approach.
That's a really important practical point for listed companies. They must state in their annual report whether they've complied with all the provisions of the code covering board structure, accountability, remuneration, and the bit most relevant for us, audit, risk, and internal control.
And if they haven't complied,
they can't just ignore it. They have to provide a full, clear explanation for why they haven't complied with a specific provision. It allows flexibility but ensures transparency. The market can then judge if the explanation is reasonable.
Let's zoom in on the audit committee. They're the crucial link between the board, the external auditors, and maybe indirectly the shareholders.
Absolutely critical body. And its composition is designed for independence. It must be made up entirely of independent, non-executive directors or NEDs.
How many?
At least 3 for larger listed companies, maybe 2 for smaller ones. And importantly, the main board chairman cannot be a member of the audit committee. They're overseeing the board, so the chair can't be part of that oversight.
And they need some financial know-how.
Yes, at least one member must have recent and relevant financial experience. Makes sense, given their role.
Which is, what are their key duties regarding us, the external auditors?
It's a broad remit. Monitoring the integrity of the financial statements, reviewing internal controls, risk management. But for us, the key things are, they are responsible for overseeing the relationship with the external auditor. This includes making recommendations on our appointment, reappointment, and removal. And crucially, they must annually assess our independence and objectivity. They're the primary check against management unduly influencing the audit. Hashtag auditor rights and professional ethics.
Okay, sticking with the regulatory side.
Uh-huh.
Auditors have specific statutory rights because they act for the shareholders. What are the key rights you need to know?
Three main ones. First, a really powerful one. The right of access at all reasonable times to the company's books, accounts, and vouchers. Basically, any information we need for the audit.
Unlimited access, effectively.
Pretty much. Second, the right to require explanations from directors and officers of the company. They have to answer our questions. Third, the right to attend any general meetings of the company, receive all the notices, and crucially, to speak at those meetings on matters concerning us as auditors.
So if things get really bad, you can go straight to the shareholders.
That's the ultimate backstop, yes. Bypasses management entirely.
What about appointment and removal? How is the auditor protected if management tries to get rid of them unfairly?
Well, appointment is usually routine reappointed each year by shareholder resolution at the annual general meeting, AGM. But removal or resignation is tightly controlled. If an auditor resigns or is removed before their term is up, they must deposit a statement of circumstances at the company's registered office.
And what does that statement do?
It's the auditor's chance to explain why they're leaving or being removed. If there are professional reasons, maybe a major disagreement about accounting policy, refusal of access, suspected fraud management isn't addressing, the auditor puts it in that statement. It goes to shareholders and regulators. It prevents management from quietly removing an auditor who's asking awkward questions.
A vital protection. Okay, let's move to the absolute bedrock. Professional ethics, Chapter 4. This applies to everyone, students included. The conceptual framework is key. Principles, threats, safeguards.
That's the structure. You start with the 5 fundamental principles. Every ACCA member and student has to adhere to these.
Let's list them.
1. Integrity. Be straightforward and honest. 2. Objectivity. Don't allow bias, conflict of interest, or undue influence to override professional judgments.
Okay.
3. Professional competence and due care. Maintain your knowledge and skill and act diligently according to standards. 4. Confidentiality. Respect the privacy of client information unless there's a legal or professional right or duty to disclose, like money laundering reporting.
Right, that's a key exception.
And 5. Professional behavior. Comply with laws and regulations and avoid any action that could discredit the profession.
Seems straightforward. But the real challenge comes when everyday situations create threats to these principles. We need to know the 5 main categories of threats.
Absolutely. This is prime exam territory. First, the self-interest threat. This is where the auditor's own financial or other interests could inappropriately influence their judgment or behavior.
Like owning shares in the client.
Classic example. Or, very commonly tested, overdue fees. If a client owes you significant fees from last year, you might be reluctant to issue a qualified opinion this year for fear they won't be able to pay you at all. That's a self-interest threat to objectivity and integrity.
What about the size of the fee itself?
Yes, high percentage fees. For public interest entities, PIEs, like listed companies, if the total fees from that client exceed 15% of the audit firm's total recurring fee income for 2 consecutive years, it creates a presumed self-interest threat. The client becomes too important financially.
And lowballing, quoting a really low fee to win the work.
That creates a self-interest threat and a threat to professional competence and due care. If the fee is too low, there's pressure to cut corners, not assign enough experienced staff, reduce sample sizes, basically not do a proper audit just to make the job break even.
Okay, threat number 2.
Self-review threat. This happens when you end up auditing work that your own firm has previously done for the client.
Like if the firm prepared the financial statements they're now auditing.
Exactly. Or maybe the firm performed internal audit services or designed the accounting system. You'd naturally be less likely to find fault with your own firm's work. It compromises objectivity. Certain services, like preparing accounts for a PIE audit client, are often prohibited for this reason.
Third threat.
Advocacy threat. This occurs when the auditor promotes the client's position to the point that their objectivity is compromised.
For instance.
Maybe promoting shares in the audit client, or acting as an advocate for the client in litigation or disputes with third parties. You've stopped being neutral. You're now arguing their case.
Fourth, familiarity threat. Getting too close, too comfortable.
Precisely. Due to a long or close relationship with the client or its staff, the auditor becomes too sympathetic to their interests or too accepting of their work. You lose professional skepticism.
And there are strict rules here, especially for PIEs.
Yes, the time-on rules. For PIEs, the engagement partner, the lead auditor signing the report, can typically only serve in that role for a maximum of 7 years. After that, they must rotate off the client.
And there's a cooling off period.
A significant one, usually 5 years before that partner can be involved with that client again. Key audit partners also have rotation requirements. It's designed to break those long-standing relationships and bring in fresh perspective, reinforcing objectivity.
7 years on, 5 off.
Hmm.
That's quite strict. It must cause some disruption for the client and firm.
It can, but the regulators believe the risk to independence from excessive familiarity, especially on major public interest audits, outweighs the continuity benefits. It's about protecting public confidence in the audit opinion. That 5-year break ensures a real detachment.
Okay. And the final threat, number 5.
Intimidation threat. This is when the auditor is deterred from acting objectively because of actual or perceived pressures.
Like being threatened with dismissal if you don't issue a clean opinion.
That's the classic example. Or being threatened with litigation. It could also be more subtle. Maybe management hints they'll report a minor unrelated issue to the ACCA, or the client threatens to withdraw lucrative non-audit work unless the audit goes smoothly. Even pressure to reduce the fee unreasonably could be intimidating.
So if any of these 5 threats exist, the framework requires us to apply safeguards.
Yes, safeguards are actions or measures that eliminate the threat or reduce it to an acceptable level. The key test is whether a reasonable and informed third party, knowing all the facts, would likely conclude that the firm's objectivity or adherence to principles is not compromised.
Where do safeguards come from?
They can be created by the profession, like ethical standards, disciplinary processes, by legislation, or within the client itself, like having a strong independent audit committee. But most often, we rely on safeguards within the audit firm.
Such as?
Things like assigning additional suitably qualified staff to the engagement, having an independent partner review the work, rotating senior personnel off the team, using different teams for audit and non-audit services, discussing issues with the audit committee. Lots of potential actions depending on the specific threat. For example, if there's a self-review threat on a tax calculation, the safeguard might be to have a tax partner who wasn't involved in preparing the calculation review the audit work on that specific area.
Right, let's move into the audit process itself. Part 2. Planning, risk assessment, evidence. The whole audit follows a logical sequence, doesn't it?
It does, broadly. Appointment right error planning, understanding the entity, assessing risk right error responding to those risks, testing controls or substantive procedures, overall review right error reporting.
Let's start right at the beginning, deciding whether to even take on a client. The acceptance stage.
Crucial stage. You're putting your firm's reputation on the line. You need to check several things before accepting. First, are we professionally qualified to do this work? Do we have the necessary expertise, staff, time resources?
Okay.
Second, can we comply with ethical requirements? Is there a threat to independence we can't safeguard? Does accepting this client push us over that 15% fee limit for PIEs?
And critically, what about the client themselves?
Yes, you must consider the integrity of the principal owners, key management, and those charged with governance, TCWG. Are they honest? Do they have a reputation for aggressive accounting or putting pressure on previous auditors? If you have serious doubts about management integrity, you should probably decline the engagement no matter how attractive the fee looks. Why risk your reputation?
This links directly to communicating with the previous auditor, right? That's mandatory.
Absolutely non-negotiable before accepting appointment. You, the potential new auditor, must ask the prospective client for permission to contact the outgoing auditor.
And if the client refuses permission?
Decline the engagement. Immediately. It's a massive red flag. It strongly suggests they're hiding something, perhaps a dispute or an unresolved issue the previous auditor raised.
Okay, assuming they grant permission and you speak to the old auditor, who also needs client permission to respond due to confidentiality, and you decide to accept, then comes the engagement letter.
Yes, the formal contract. ISA 210 covers this. It sets out the terms of the engagement, avoiding misunderstandings. It must include the objective and scope of the audit, the responsibilities of the auditor, and importantly, the responsibilities of management.
What are management's key responsibilities listed in the letter?
Management is responsible for preparing the financial statements according to the applicable framework, like IFRS, and they're responsible for implementing the internal control necessary to enable that preparation, ensuring the statements are free from material misstatement, whether due to fraud or error.
And the auditor's responsibility.
Our responsibility is to express an opinion on those statements based on our audit conducted in accordance with ISAs. The letter will also mention the inherent limitations of an audit, that risk of non-detection, meaning we provide reasonable, not absolute assurance. Oh, and it usually outlines the fee basis and billing arrangements.
Okay, engagement accepted, letter signed. Now planning, ISA 300. It talks about an overall strategy and a detailed plan.
That's right. The audit strategy sets the overall scope, timing, and direction of the audit. It's the high-level view. What are the key risks? Do we need specialists? What's the reporting deadline? Where will we focus our efforts?
And the audit plan.
That's much more detailed. It describes the specific nature, timing, and extent of the risk assessment procedures and the further audit procedures, tests of controls, substantive tests, plan for specific account balances or transaction streams. It's the detailed work program. Good planning is essential for an efficient and effective audit, ensuring resources go where they're needed most. ### understanding and audit risk.
Planning goes hand in hand with understanding the client. You can't plan without knowing what you're auditing. What aspects of the entity does ISA 315 say we must understand?
We need a solid grasp of the entity and its environment. That includes its operations, its ownership and governance structures, the industry it's in, regulatory factors, its business model, how it uses IT.
And the accounting side.
Yes. The applicable financial reporting framework, IFRS, usually and critically, the entity system of internal control. We need to understand its design and implementation. Do controls actually exist? Are they being used? Can we potentially rely on them?
How do we get this understanding? Just ask management.
Asking management is part of it, but it's not enough. The standard mandates specific risk assessment procedures. These must include inquiries talking to management, finance staff, internal auditors, maybe legal counsel, analytical procedures looking at trends, ratios, comparisons to budgets or prior years to identify unusual fluctuations that might indicate risks, and observation and inspection watching processes happen, like goods receiving or inspecting documents like procedure manuals or board minutes.
This understanding feeds directly into assessing risk. And that brings us to the absolute core theoretical concept, heavily tested, the audit risk model, AR equal IR x CR x DR. Break it down for us.
Okay, audit risk, AR, is the ultimate risk we face. The risk that we issue the wrong opinion, specifically giving an unmodified, clean opinion when the financial statements are actually materially misstated. We want to reduce this risk to an acceptably low level.
And it's made up of two main components.
Yes. The first component is the risk of material misstatement. This is the risk that the financial statements are materially misstated before we even start our detailed audit work. The auditor doesn't control this. It's inherent to the client and its environment.
Roman itself breaks down further.
Into two parts. Inherent risk, IR, is the susceptibility of an assertion, say, valuation of inventory to material misstatement, assuming there are no related controls. Some things are just inherently riskier than others. Complex transactions, high-value items attractive to theft, like cash, areas involving significant judgment or estimation, or companies under pressure to meet targets.
Okay, that's IR with CR.
Control risk, CR, is the risk that a misstatement that could occur, inherent risk, will not be prevented or detected and corrected on a timely basis by the client's internal control system. Basically, the risk the client's controls will fail.
So Roman is IR times CR. The misstatement exists in the first place, compounded by the risk the client's controls won't catch it.
Exactly. And remember, the auditor assesses IR and CR based on their understanding, but they can't change them.
So the only part of the model the auditor can influence is the third component. Precisely. Detection risk, DR, is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will fail to detect a misstatement that exists and that could be material either individually or when aggregated.
So it's the risk our tests miss something important.
Yes, and the model shows the relationship AR equals rho M, IR x S, DR. This means there's an inverse relationship between rho and .r.
Explain that. How does it drive the audit strategy?
If our assessment finds that rho is high, maybe because the client has complex derivatives, high IR, and their controls over financial reporting are weak, high CR, then to keep overall audit risk, AR, low, we must set detection risk, DR, low.
And how do we achieve low detection risk? By doing more work. We need to increase the nature, timing, and extent of our substantive audit procedures. Nature means using more reliable procedures, for example, external confirmations instead of just internal inquiry. Timing might mean doing more work at or after the year end rather than relying on interim testing. Extent means larger sample sizes, testing more items.
Conversely, if Rome is assessed as low, maybe a simple business with strong controls.
Then we can accept a higher level of detection risk and still achieve our target low audit risk. That means we can perhaps do less expensive substantive testing, maybe rely more on controls testing, use smaller samples, maybe do more work at an interim date. It allows for a more efficient audit.
And we need to think about risk at two different levels, right?
Yes, risk can exist at the overall financial statement level. These are risks that relate pervasively to the financial statements as a whole and could affect many assertions. Examples include management override of controls, concerns about the company's ability to continue as a going concern, or a poor tone at the top regarding ethics.
And the other level.
Risk at the assertion level. These risks relate to specific classes of transactions, account balances, or disclosures. For example, the risk that inventory is overvalued relates specifically to the valuation assertion for inventory, or the risk that sales revenue is overstated relates to the occurrence assertion for revenue. Our detailed audit procedures are designed primarily to address risks at the assertion level. ## evidence and sampling techniques.
Okay, so we understand the client, we've assessed the risks. Now we need to gather evidence to respond to those risks. Chapter 10. What are the main types of audit procedures we use? Any mnemonics?
The classic one uses the vowels, A, E, I, O, U. It's a good way to remember the categories. A is for analytical procedures evaluating financial information by studying plausible relationships among both financial and non-financial data. Basically, ratio analysis, trend analysis, comparisons. E is for inquiry seeking information from knowledgeable persons inside or outside the entity, and also external confirmation getting evidence directly from third parties. A is for inspection examining records, documents, or tangible assets. O is for observation looking at a process or procedure being performed by others, like observing the client's inventory count. And U is for recalculation and reperformance. Recalculation is checking mathematical accuracy. Reperformance is independently executing procedures or controls that were originally performed as part of the entity's internal control.
Let's focus on analytical procedures for a moment.
Yeah.
They're used at different stages, aren't they?
Yes. Critically, they're used at 3 stages. At the planning stage, they're mandatory as part of risk assessment. Identifying unusual changes like, say, inventory days jumping from 30 to 90 helps direct our attention. They can also be used during the substantive testing stage, sometimes providing sufficient evidence on their own for low-risk areas or reducing the need for detailed tests. And they are required again at the overall review stage. The partner does a final check to see if the financial statements as a whole make sense based on their understanding of the business and the audit findings. It's a final sniff test.
Now, the assertions. This is absolutely vital for structuring answers in Section B. Management makes implicit claims with every number in the accounts. We need to clearly separate assertions for transactions during the period versus balances at the year-end.
Couldn't agree more. Let's start with transactions and events for the period. Think sales, purchases, expenses. The key assertions using the ACCA cover mnemonic or similar are occurrence. Did the transaction actually happen and pertain to the entity? Risk of overstatement. Completeness. Were all transactions that should have been recorded actually recorded? Risk of understatement. Accuracy. Were the amounts recorded correctly? Cutoff. Were transactions recorded in the correct accounting period? Classification. Were transactions recorded in the proper accounts? Presentation. Are transactions appropriately aggregated or disaggregated and clearly described in the notes?
Okay, that's transactions. Now, for account balances at the period end, receivables, payables, inventory, cash, NCAs. What are the assertions here?
Similar concepts, but slightly different focus. Again, ACCA cover helps. Existence. Do the assets, liabilities, and equity interests actually exist? Risk of overstatement for assets, rights and obligations. Does the entity hold or control the rights to assets, and are the liabilities the obligations of the entity? Completeness. Have all assets, liabilities, and equity interests that should have been recorded? Risk of understatement for liabilities. Accuracy, valuation, and allocation. Are they included at appropriate amounts, and are any valuation adjustments, like provisions, correctly recorded? Classification. Recorded in the proper accounts. Presentation. Appropriately aggregated, disaggregated, and clearly described.
Students often confuse occurrence existence with completeness. Can you give a practical tip on how the direction of testing helps distinguish them?
Sure. Think about the main risk. For liabilities like trade payables, the biggest risk is usually understatement. So we focus on completeness. To test completeness, you start from the source evidence outside the ledger, like supplier invoices or goods received notes, and you trace them forward into the payable ledger to make sure they got recorded. You're looking for things that should be there but aren't.
Okay, trace forward from source for completeness. What about assets like trade receivables?
For assets, the main risk is usually overstatement claiming assets that don't exist or aren't owned. So we focus on existence or occurrence. Here, the direction is reversed. You start with the item already in the financial statements, the receivable balance in the ledger, and you vouch it back to the supporting evidence like shipping documents and sales invoices to prove it's real and relates to a genuine sale. You're confirming that what is recorded actually happened.
Vouch back from ledger for existence occurrence. That's helpful. Now, audit sampling, Chapter 11. We can't test everything, so we sample. But the sample has to be representative if we want to draw conclusions about the whole population.
Absolutely. If the sample isn't representative, any statistical projection of errors is invalid. So the selection method matters. Ideally, every item in the population should have a known chance of selection.
What are the common selection methods?
Random selection using random number generators ensures every item has an equal chance. Systematic selection involves selecting items using a constant interval, for example, every 50th invoice, after a random start. Both can provide a representative sample if used properly.
What about methods to avoid if you want a statistically valid sample?
Haphazard selection, where the auditor just picks items without any structured technique, looks random, but is prone to unconscious bias, so it's not truly representative. Block selection, choosing a sequence of items, like all sales invoices for May, is almost never representative of the whole year's transactions. Avoid these for projecting errors.
There's also monetary unit sampling, or MUS.
Yeah.
Why is that often used in substantive testing?
MUS is clever. It's a type of value-weighted selection. Instead of giving each transaction or balance an equal chance of selection, it gives each individual dollar or pound or euro an equal chance. This automatically increases the likelihood that larger monetary value items will be selected in the sample.
So it naturally focuses testing on the bigger items.
Exactly. Since material misstatements are more likely to occur in high-value items, MUS automatically stratifies the population and directs the audit effort towards the areas of greatest potential monetary error. It's very efficient for testing overstatement in assets like receivables or inventory.
And once we've tested the sample, say using MUS, how do we evaluate the results?
You determine the amount of misstatement found in the sample items. Then you have to project that misstatement over the entire population to estimate the total likely misstatement. For MUS, the projection method is specific, but the principle is the same.
And then compare that projection to
Your tolerable misstatement. That's the maximum misstatement you decided you could accept in that population during planning, often related to performance materiality. If the projected misstatement is less than tolerable misstatement, you might conclude the population is okay. But if the projected misstatement exceeds tolerable misstatement,
then you have a problem.
big problem. You need to understand why the errors occurred. You might need to perform additional procedures, maybe test a larger sample, or ask management to investigate and correct the entire population. Ultimately, if material misstatement remains uncorrected, it will lead to a modified audit opinion.
Okay, now we're into the real engine room of the audit. Heavily tested in Section B, internal controls and substantive procedures. Chapters 12 through 22 cover this ground. First up, how do auditors actually record the client's internal control system to understand it?
There are three main ways. You can use narrative notes, basically, just writing a description of the system. It's flexible but can be cumbersome for complex systems and might miss key controls or weaknesses.
What else?
Flowcharts. These are often preferred, especially for complex cycles like sales or purchases. They provide a visual representation of the flow of documents and information, and they make it really easy to see where controls are operating or where segregation of duties might be lacking. They impose a certain discipline.
And the third method?
Questionnaires. There are two types. Internal control questionnaires, ICQs, are lists of standard yes-no questions about whether specific controls exist. For example, are purchase orders authorized before being sent? Internal control evaluation questionnaires, ICQs, are a bit more sophisticated. They focus on control objectives, figures are controls adequate to ensure all goods received are recorded, and require more judgment from the auditor based on their understanding.
Once we've recorded it, we need to understand its components. CSO framework identifies 5 components of internal control. What's the foundation?
The control environment. This is absolutely fundamental. It's the tone at the top. Management's philosophy, operating style, commitment to integrity and ethical values, how they assign authority and responsibility. If the control environment is weak, if management doesn't care about controls or routinely overrides them, then even well-designed specific controls might not be effective.
So culture matters. What are the other four components?
The entity's risk assessment process, how management identifies and responds to business risks. The information system, including the related business processes relevant to financial reporting, how transactions are initiated, recorded, processed, reported, control activities, the specific policies and procedures, and monitoring of controls, management assessing control performance over time, often involving internal audit.
Let's focus on those control activities. These are the specific checks and balances we often test. What are the key types?
The big one is segregation of duties. Absolutely critical. Different individuals should be responsible for authorizing transactions, recording them, and having custody of the related assets. You don't want the same person approving a purchase, recording the payable, and making the payment. That invites fraud. Authorization and approval limits. Performance reviews, like comparing budgets to actuals. Information processing controls. Application controls in IT systems. General IT controls. Physical controls, like locking up inventory or cash, and accounting reconciliations, like bank reconciliations, reconciling supplier statements to the payables ledger.
Exam questions often describe a system and ask you to identify weaknesses, explain the consequence, and recommend improvements. Give us a classic example using that structure.
Okay, common one. In the payroll system, the HR department can add new employees to the payroll master file, and the payroll department processes payments based on that master file. But there's no independent check that new joiners actually exist or that leavers are promptly removed.
Okay, what's the weakness, consequence, recommendation?
The problem, weakness, is the lack of segregation of duties and independent verification of master file changes. The consequence, risk, is that fictitious ghost employees could be added and paid, or leavers could continue to be paid, leading to fraudulent payments and overstated expenses. The recommendation would be HR should notify payroll of starter leavers using a formal authorized notification form. Payroll should process changes based only on this form. And periodically, a senior manager independent of both departments should review the payroll list against HR records and perhaps even physically verify employee existence on a sample basis.
Problem, consequence, recommendation. Got it. But even great systems have limitations, right? This links back to reasonable assurance.
Absolutely. No system is perfect. Key inherent limitations include the basic fact that controls must be cost-effective. Management won't implement a control if the cost outweighs the benefit. The potential for human error, people make mistakes, misunderstand instructions, get careless. The possibility of collusion, two or more people working together, can often circumvent controls, especially segregation of duties.
And the most dangerous one.
Management override. Senior management is often in a position to deliberately bypass or override controls that apply to other employees. They might do it for legitimate reasons, like an urgent transaction, or, unfortunately, to perpetrate fraud. It's very difficult to design controls that absolutely prevent management override.
So, given these limitations, when do we actually bother testing the controls we've identified?
We only perform tests of controls if two conditions are met. First, we expect the controls to be operating effectively based on our understanding. If they look weak on paper, there's no point testing them. Second, we intend to rely on that effectiveness to reduce the extent of our substantive testing. If we plan to do full substantive testing anyway, testing controls might be inefficient.
And if we do test controls, what procedures do we use? Is just asking management enough?
Definitely not. Inquiry alone is never sufficient evidence for testing controls. We must combine it with other procedures like inspection of documents for evidence of the control being performed. For example, looking for an authorization signature, a reconciliation tick mark, a supervisor review initial. Observation of the control being performed. For example, watching the mailroom clerk opening mail and listing checks received. And reperformance, independently executing the control ourselves. Example, reperforming the bank reconciliation.
If our tests find weaknesses, especially significant ones, how do we communicate them?
We communicate deficiencies in internal control found during the audit to management, and for significant deficiencies, also to those charged with governance, like the audit committee. This is usually done formally in writing, often called a management letter or letter of weakness.
And the structure for reporting those points.
Again, that three-part structure is best for clarity in getting marks. Clearly identify the problem or deficiency found. Explain the potential consequence or risk arising from it. And provide a practical, constructive recommendation for improvement. Hashtag IT controls and ATTs.
Let's touch on IT controls specifically.
Yeah.
Chapter 15. Everything's computerized now. We usually divide IT controls into two broad categories.
Yes. General IT controls, GITCs, are policies and procedures that relate to many applications and support the effective functioning of application controls. They create the overall control environment for IT. Think about controls over data center operations, system software acquisition and maintenance, access security, passwords, user rights, and program development and changes.
And the other category.
Information processing controls, often called application controls. These are automated or manual procedures that typically operate at a business process level, embedded within specific application software, like sales, purchasing, payroll. They relate to the processing of individual transactions.
Application controls often focus on the famous G.I. Joe principle, garbage in, garbage out. So input controls are vital. Examples.
Absolutely crucial. Input controls aim to ensure data entered is authorized, complete, and accurate. Examples include sequence checks on pre-numbered documents, like invoices, to ensure none are missing. Format checks, for example, ensuring only numbers are entered in a numeric field. Range checks, for example, flagging if hours worked exceed, say, 80 per week. Reasonableness checks, comparing data to expected values. And control totals or batch totals, calculating totals before input, like total sales value, and comparing it to the system's process total afterwards to check for completeness and accuracy.
What about standing data? Data that doesn't change often but is used repeatedly.
Yes, things like customer credit limits, supplier bank details, standard selling prices, employee pay rates. This is standing data or master file data. The risk here is that if an error gets into the standing data, for example, a wrong price, it will cause a persistent error affecting potentially thousands of transactions until it's corrected.
So controls over changes to standing data are critical.
Extremely critical. Access to changed standing data should be restricted. Changes should require specific authorization. And there should be regular independent reviews or printouts of standing data checked back to source documents or authorizations by a manager who is independent of the transaction processing function.
Auditors themselves now use IT extensively. Let's talk about automated tools and techniques, ATTs, sometimes called CATs, computer-assisted audit techniques. We need to distinguish between using software to test data versus testing the client system.
Good distinction. Audit programs or audit software, sometimes called Generalized Audit Software or GAS, are programs used by the auditor to interrogate and analyze the client's live data files. We can use it to reperform calculations like aging receivables, select samples based on criteria, example, all transactions over $6, or transactions with unusual characteristics, identify gaps in sequences, compare data across different files, basically substantively testing the data itself on a large scale.
Okay, that's testing the data. What's the other main type of ATT?
Test data. This is completely different. Here, the auditor creates a set of dummy transactions, some valid, some invalid, e.g., wrong codes, values outside limits, unauthorized user IDs, and processes this dummy data using the client's actual application program. The purpose is to see if the client's programmed controls, the application controls, correctly identify and reject the invalid data and correctly process the valid data. We're testing the system's control logic, not the client's live data. Hashtag key substantive audit areas.
Right. Let's get into the details of substantive testing for key count balances. This is bread and butter AA stuff, core section B material, starting with trade receivables, chapter 17, key risks, existence, are they real, and valuation will collect them.
Absolutely. The primary procedure for testing existence and often accuracy is external confirmation, better known as circularization, sending letters directly to the client's customers asking them to confirm the balance they owe. It's powerful because it's external evidence obtained directly by the auditor.
Two types of confirmation requests.
Yes, positive confirmation asks the customer to reply whether they agree with the balance shown or state the amount they believe is correct. You expect a reply in all cases. This gives better evidence, but takes more follow-up if they don't reply. Preferred when a risk is high or balances are large unusual. Negative confirmation asks the customer to reply only if they disagree with the balance shown. Simpler, less work if few disagreements are expected, but the lack of a reply gives much weaker evidence. Does it mean they agree or they just ignored it? Only suitable if Rome is low, controls are strong, the population has many small balances, and we don't expect many errors.
And the auditor must control the whole process.
100%. To ensure the reliability of the evidence, the auditor must control the selection of customers, the preparation and sending of the letters using our return address, and the receipt of the replies directly. If the client handles any part of this, the independence and reliability are compromised.
What if you send positive confirmations and get no reply?
You must perform alternative procedures for non-replies. This usually involves examining subsequent cash receipts from that customer after the year end, strong evidence they owed the money, or examining supporting documents like signed delivery notes and sales invoices relating to the balance.
Okay, confirmation tackles existence accuracy. How do we audit the valuation assertion, the risk the debt won't be collected?
Valuation is about the allowance for doubtful debts or bad debt provision. Procedures here include reviewing the age receivables listing how old are the debts. Older debts are less likely to be collected. Discussing overdue balances with the credit control department. Calculating the receivables collection period ratio and comparing it to prior years or industry data.
And the best evidence of collectability.
Examining cash received after the year end from those specific debtors. If they paid up in January, it's pretty good evidence the debt was good at December 31st. Also, scrutinize credit notes issued after the year end. Could these relate to sales recorded before year end that should have been reversed? It might indicate inflated profits or unrecorded returns allowances.
Let's flip to trade payables, Chapter 18. Here, the main risk is usually the opposite: completeness, understatement, finding liabilities the client hasn't recorded.
Exactly. The focus shifts. We need to perform a search for unrecorded liabilities, SURL. The single best procedure here is often supplier statement reconciliations. We obtain statements directly from major suppliers and reconcile them to the client's payables ledger balance for that supplier. Discrepancies often highlight unrecorded invoices or accruals.
What else is involved in the SURL?
Reviewing payments made shortly after the year end. If a payment in early January relates to goods or services received before the year end, was the corresponding liability recorded or accrued at year end? We should trace large post-year-end payments back to supporting invoices and receiving documents to check the cutoff.
And checking goods received records.
Yes, reviewing the file of goods received notes, GRNs, just before and after the year-end. For GRNs dated before year-end, we trace them to ensure a corresponding payable or accrual has been recorded. If goods arrived but the invoice hasn't been received by year-end, there should be a goods received not invoice, GRNI, accrual. We test that accrual for completeness and accuracy.
Okay, inventory, Chapter 19, always a high-risk area. Physical existence, complex valuation, potential for theft, obsolescence.
Right.
Key assertions, existence, completeness, valuation, cutoff. The big procedure is the stock take observation.
Right. The auditor attends the client's physical inventory count. We don't do the count for them, but we observe management's procedures. Are the count instructions adequate? Are they being followed? Are count teams organized? Is movement of goods controlled during the count?
And we do some counting ourselves.
We perform test counts. Crucially, we test in two directions. To test completeness, are all physical items included in the records? We select items from the warehouse floor and trace them to the client's count sheets or inventory records, physical radar, a book. To test existence, are all items on the records physically present? We select items from the count sheets or inventory listing and physically locate them on the warehouse floor, book radar, a physical.
What about inventory held at third-party locations?
We'd normally seek direct confirmation from the third party regarding quantities and condition. If the amount is significant, we might even consider visiting the third party to observe their count or arranging for another auditor to do so.
Now, valuation. Inventory should be valued at the lower of cost and net realizable value, NRV.
Standard rule, IS2. We need to test both parts. For cost, we trace items back to purchase invoices for raw materials goods for resale, or review cost accumulation records for work in progress and finished goods, checking components like materials, labor, and overhead allocation.
And testing NRV.
NRV is the estimated selling price less estimated costs to complete and sell. We look for evidence of slow-moving, obsolete, or damaged inventory during the stocktake observation. We review sales prices achieved after the year-end for similar items. We analyze inventory aging reports. If cost exceeds NRV for any items, they must be written down, and we check the adequacy of any inventory provision.
And cutoff is absolutely critical for inventory, purchases, and sales.
Huge potential for profit manipulation here. At the stock take, we must record the serial numbers of the last GRNs and goods dispatch notes, GDNs, used before the counts started and the first ones used after. We then trace these into the accounting records to ensure transactions around the year-end are recorded in the correct period. Goods received before year-end must be in purchases payables and included in closing inventory. Goods dispatched before year-end must be recorded as sales receivables and excluded from closing inventory. Consistency is key.
Non-current assets, NCAs, Chapter 20. We physically inspect major assets to confirm existence. How do we confirm rights and obligations that the company actually owns them?
We inspect documents of title. For property, that's title deeds. For vehicles, registration documents. We also review lease agreements for right-of-use assets.
What about checking additions and disposals, authorization and accuracy?
We vouch significant additions back to purchased invoices and contracts. We check board minutes for authorization of major capital expenditures and disposers. For disposals, we check the calculation of profit or loss on disposal, ensuring the asset and accumulated depreciation are correctly removed.
And a key procedure for ensuring completeness of NCA additions and correct classification.
Scrutinizing the repairs and maintenance expense account in the income statement. Management might incorrectly expense items that should have been capitalized to reduce profits or avoid capital expenditure controls. We look for large or unusual items in repairs and trace them back to invoices to assess if they meet the criteria for capitalization under IAS 16.
And don't forget depreciation.
Never. We check the reasonableness of depreciation rates and methods used, ensuring consistency with prior years and asset useful lives, and we reperform the depreciation calculation for a sample of assets or use analytical procedures on the overall charge to check for accuracy. #tag using the work of others.
Okay, sometimes we don't do all the work ourselves. We might rely on internal audit or use an expert, Chapter 23. Let's start with internal audit. Can we just assume their work is reliable?
Absolutely not. ISA 610 sets out strict conditions. Before using the work of the internal audit function, IAF, the external auditor must evaluate three things. First, the extent to which the IAF's organizational status supports its objectivity. Does it report to the audit committee or just the finance director? Does it have sufficient independence from the managers it audits? Second, the level of competence of the IAF. Are the internal auditors technically trained? Do they have adequate resources, professional qualifications? Third, whether the IAF applies a systematic and disciplined approach, including quality control. Do they plan, document, supervise, and review their work properly?
And only if we're satisfied on all three counts can we consider relying on their work.
Yes. And even then, we must decide which specific work we might rely on, and we still need to perform sufficient procedures on that work to ensure it's adequate for our external audit purposes. We can never delegate our overall responsibility or judgment.
What about using an auditor's expert? Someone like a property valuer, an actuary for pension liabilities, or an environmental consultant?
ISS 620 applies here. Similar principles. We must evaluate the expert's competence, qualifications, experience, capabilities, resources to do the job, and crucially, their objectivity. Are they independent of the client? Are they employed by the client, a management's expert? Is their fee contingent on the outcome?
And we need to understand their work.
Yes, we need to obtain an understanding of their field of expertise. Agree on the scope and objectives of their work, preferably in writing, especially if it's an auditor's expert we engaged, and evaluate the appropriateness of their work as audit evidence. This means considering the reasonableness of their findings, the consistency with other evidence, and the assumptions and methods they used. We can't just accept their report blindly.
Right, we're nearing the end of the process. We've gathered evidence, maybe used experts. Now it's time for review, documentation, and reporting, Chapters 24 onwards. Why is audit documentation so important? ISA 230.
It's fundamental for several reasons. It provides the principal record of the basis for our audit report. It's the evidence that the audit was planned and performed in accordance with ISAs and legal regulatory requirements. If we get sued or inspected, the working papers are a primary defense.
And it helps the team.
Yes, it enables the engagement team to be accountable for its work. It facilitates supervision and review by more senior staff. It helps future audit teams understand the client and the work performed previously.
How is it typically organized?
Usually into two main files. The permanent file contains information of continuing importance, things like the engagement letter, legal documents, memorandum, articles, long-term contracts, details of the accounting system, previous year's audited accounts. The current file contains information relevant primarily to the current year's audit. the financial statements being audited, planning documentation, the detailed working papers showing procedures performed, evidence obtained, issues identified, and conclusions reached for each audit area.
And what makes a good working paper?
It should be clear enough for an experienced auditor with no previous connection to this specific audit to understand the work done, the evidence obtained, the basis for the conclusions reached, and who performed and reviewed the work and when. It needs purpose, precise details, source references, and a clear conclusion.
Quality management, ISA 220, is key throughout. The engagement partner has ultimate responsibility. But for PIEs, there's an extra layer of quality review.
Yes, the Engagement Quality EQ Review, sometimes called the Engagement Quality Control Review, EQCR, or HOT Review. For audits of listed entities and other PIEs, and often other high-risk engagements as required by firm policy, an independent review must be performed before the audit report is dated.
Independent meaning?
Performed by another partner or equivalent senior person within the firm or externally who is not part of the engagement team. Their role is to provide an objective evaluation of the significant judgments the engagement team made and the conclusions reached in formulating the audit report. It's a crucial safeguard for audit quality on high-profile audits.
Okay, let's talk about specific issues that arise late in the audit. Fraud, Chapter 25. We need to distinguish it from error.
Key difference is intent. Error is an unintentional mistake in financial statements, miscalculation, misapplication of accounting principles, oversight. Fraud is an intentional act by one or more individuals involving deception to obtain an unjust or illegal advantage.
Two main types of fraud relevant to auditors.
Yes. Fraudulent financial reporting, intentionally misstating the accounts, often by management, maybe to deceive users, meet targets, or boost bonuses, for example, fictitious sales, improper revenue recognition, concealing liabilities. And misappropriation of assets, basically. Theft of company assets, often by employees. Example, stealing cash or inventory, fraudulent expenses claims.
And the auditor's responsibility regarding fraud.
It's the same as for error. To obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether caused by fraud or error. Management is primarily responsible for prevention and detection of fraud through internal controls. We are responsible for maintaining professional skepticism throughout the audit and designing procedures to respond to assessed risks of material misstatement due to fraud.
Subsequent events, Chapter 26. Things happening after the year-end date but before we sign our report. IAS 10 tells us how to treat them. Two types.
Correct. Adjusting events are those that provide evidence of conditions that existed at the reporting date, the balance sheet date. If material, these require the financial statements to be adjusted.
Its example.
A major customer owing money at year-end goes bankrupt in January due to long-standing financial difficulties that were present in December. This provides evidence that the receivable was impaired at the year-end, so an adjustment, increased bad debt provision, is needed.
And the other type?
Non-adjusting events. These are indicative of conditions that arose after the reporting date. They don't affect the figures in the financial statements, but if they are material, they require disclosure in the notes to the accounts so users aren't misled.
Example.
A major factory burning down in February after a December year-end, or a major acquisition or disposal agreed after year-end. These don't change the December 31st position, but they're crucial information for users understanding the company's future prospects, so they must be disclosed.
How long were we responsible for considering subsequent events?
We have an active duty to perform procedures to identify subsequent events right up until the date we sign the auditor's report. After that date, our duty becomes passive. We don't have to look anymore, but if we do become aware of a fact that existed at the report date, which might have caused us to change our report, we must discuss it with management and consider further action, like revising the report, or FS. #tag contingencies and representations.
Contingencies, Chapter 27, governed by IAS 37. Another area testing judgment and prudence. Let's start with contingent liabilities.
A contingent liability is either a possible obligation arising from past events whose existence will be confirmed only by uncertain future events, not wholly within the entity's control, or a present obligation that's not recognized because either it's not probable an outflow of resources will be required or the amount cannot be measured reliably.
So how do we treat them? Depends on probability.
Exactly. If the outflow is probable, more likely than not, and can be reliably estimated, you recognize a provision, a liability on the balance sheet. If the outflow is only possible, less likely than probable but more than remote, you don't recognize a provision, but you must provide disclosure in the notes. If the outflow is remote, very slight chance. You generally do nothing, no provision, no disclosure.
Okay, that's liabilities. What about contingent assets? Same rules.
No, treatment is much more cautious, reflecting the principle of prudence. A contingent asset is a possible asset arising from past events whose existence will be confirmed by uncertain future events. You never recognize a contingent asset on the balance sheet.
Never. What if the inflow is probable?
Even if probable, you only provide disclosure in the notes. You only recognize the asset and related income when the inflow becomes virtually certain, at which point it's no longer contingent. The threshold for recognizing assets income is much higher than for liabilities expenses. Asymmetrical treatment.
Got it. Final piece of evidence gathering. Written representations, Chapter 28, ISA 580. What are these?
This is a formal letter, written by management, and sometimes TCWG, addressed to the auditor, dated the same day as the audit report. It confirms certain matters and supports other audit evidence.
What kind of matters does it confirm?
Primarily, it confirms management's acknowledgement of their responsibilities for preparing the financial statements, for designing and implementing internal control, and that they believe they've fulfilled these responsibilities. It also confirms they've provided the auditor with all relevant information and access agreed in the engagement letter.
Does it cover specific assertions too?
Yes, particularly assertions that are difficult to corroborate with other evidence, especially those relating to management intent. For example, their plans for classifying investments or plans that might affect going concern. It also confirms the completeness of information provided regarding related parties, subsequent events, and known actual or suspected fraud.
So it sounds really important, especially for completeness. Can it substitute for other audit procedures? If management gives us a rep letter saying inventory is complete and fairly valued, do we still need to observe the stock take?
Absolutely not. This is a critical point. Written representations provide necessary audit evidence, but they do not provide sufficient appropriate evidence on their own about any of the matters they deal with. They support other evidence, they don't replace it, they are inherently subjective coming from the responsible party. You still need to perform all other necessary audit procedures, observe the stock take, test valuations, confirm receivables, etc.
What happens if management refuses to provide a required representation?
That's a major issue. It constitutes a scope limitation. The auditor must question management's integrity and reevaluate the reliability of all other representations received. Depending on the nature of the representation refused, it will likely result in either a qualified opinion or, if pervasive, a disclaimer of opinion. Hashtag the auditor's report modified opinions.
Okay, the culmination of everything. The auditor's report, Chapters 5, 6, and 29. The opinion depends entirely on whether we found material misstatements or couldn't get enough evidence. And that hinges on materiality.
Materiality underpins the whole audit. Information is material if its omission or misstatement could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. We determine materiality at the planning stage and revise it if necessary.
We use quantitative benchmarks.
Yes, common quantitative rules of thumb are used as a starting point. Maybe 5–10% of profit before tax, 0.51% of revenue, 1–2% of total assets. These are just guidelines. Judgment is required.
But it's not just about the numbers, is it? Qualitative factors matter too.
Hugely. Qualitative materiality means some misstatements might be considered material even if they're below the quantitative thresholds. Examples include misstatements that change a profit into a loss or vice versa, affect compliance with loan covenants, relate to director remuneration or related party transactions, sensitive disclosures, conceal an illegal act, or allow management to meet analyst forecasts or trigger bonus targets. These qualitative aspects often override the pure numbers.
Yeah, and we also use performance materiality.
Yes. Performance materiality is set by the auditor at less than materiality for the financial statements as a whole. It's used during the audit when performing procedures and evaluating errors found. It acts as a buffer, reducing the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality for the financial statements overall.
Okay, so materiality decided. Now, if we do have issues, we need the modification matrix to determine the right opinion. 2 potential problems, 2 levels of severity.
Exactly. The 2 problems are, 1, the financial statements are materially misstated, for example, wrong accounting policy, inadequate disclosure, unreasonable estimate. 2, we were unable to obtain sufficient appropriate audit evidence, a scope limitation, e.g. couldn't observe inventory, client records destroyed.
And the 2 levels of severity.
Material but not pervasive versus material and pervasive. Not pervasive means the issue is material, but it's confined to specific elements or accounts and doesn't fundamentally undermine the financial statements as a whole. You can isolate the problem.
And pervasive.
Pervasive is much more serious. An issue is pervasive if it's not confined to specific elements, affects numerous accounts, or if it is confined but represents a substantial proportion of the financial statements, like, say, 70% of assets, or if it relates to disclosures that are fundamental to users' understanding, like going concern disclosures. It basically means the financial statements taken as a whole are potentially misleading.
Right. Let's populate the matrix. What if we have a material misstatement, but it's not pervasive? Like inventory is materially overstated, but everything else is fine.
That results in a qualified opinion due to material misstatement. The opinion paragraph will state that, in our opinion, except for the effects of the matter described in the basis for qualified opinion paragraph, the financial statements present fairly.
Okay. What if we have a lack of sufficient evidence, but again, it's not pervasive, couldn't audit one subsidiary, but it's not a huge part of the group?
That also results in a qualified opinion, but this time due to inability to obtain sufficient appropriate evidence. The wording is similar. In our opinion, except for the possible effects of the matter described in the basis for qualified opinion paragraph. We use possible effects because we don't know if it's misstated, only that we couldn't check.
Now, for the pervasive problems, what if the financial statements are materially misstated and the misstatement is pervasive? Management refuses to consolidate a major subsidiary, making the group accounts fundamentally misleading.
That requires an adverse opinion. This is the worst opinion you can give on the numbers themselves. The auditor states flatly, in our opinion, because of the significance of the matter described in the basis for adverse opinion paragraph, the financial statements do not present fairly.
A direct negative conclusion. And the final box. Lack of sufficient evidence, and that lack is pervasive. Record destroyed in a fire, management blocked access to key areas. We just couldn't do the audit properly.
That results in a disclaimer of opinion. We state that because of the significance of the matters preventing us from gathering evidence, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion, and accordingly, we do not express an opinion on the financial statements. We're saying we simply couldn't form an opinion.
So, qualified except for, adverse do not present fairly, disclaimer, we do not express an opinion.
Got it.
Are there other paragraphs we might add that don't modify the opinion itself?
Yes, important ones. An emphasis of matter, EOM paragraph, is used to draw users' attention to a matter that is appropriately presented or disclosed in the financial statements, but which the auditor considers fundamental to users' understanding. It doesn't change the opinion. Classic example. Highlighting significant uncertainty disclosed by management about the outcome of major litigation or a major catastrophe after year-end that was properly disclosed. A material uncertainty related to going concern, MUGC paragraph, is mandatory if a material uncertainty exists regarding the entity's ability to continue as a going concern, and management has adequately disclosed this uncertainty in the financial statements. Again, the opinion remains unmodified, present fairly, but this separate paragraph highlights the disclosed risk. If it wasn't adequately disclosed, it would lead to a qualified or adverse opinion instead. And finally, an other matter, OM paragraph, refers to a matter not presented or disclosed in the financial statements that the auditor believes is relevant to users' understanding of the audit, the auditor's responsibilities, or the auditor's report. For instance, reporting on inconsistencies between the audited financial statements and other information presented in the annual report, like the director's report. Hashtag, tag, outro.
Wow, okay. We have covered a huge amount of ground there. From the ethical foundations, independence, objectivity, those 75 PIE rotation rules, right through planning using the audit risk model, AR equals IRX, CRX, DR, understanding how client risk dictates our detection risk, to the real core of Section B, understanding controls, identifying weaknesses using that problem consequence recommendation framework, and crucially, performing assertion-based substantive tests. Knowing why you do a supplier statement reconciliation, completeness of payables, or a debtor circularization, existence of receivables.
Exactly. And seeing how every single step, understanding the client, assessing risk, gathering evidence, evaluating findings against materiality, all leads logically towards that final opinion and the potential modifications based on the matrix. It all connects.
That structure is key for the exam. Remember, 70% is Section B, those scenario questions demanding analysis, judgment, application, mainly in planning, controls, and evidence. If you can confidently spot a risk in a scenario, say potential slow-moving stock, link it to the key assertion, valuation. And then describe specific, relevant audit procedures, review aged inventory reports, check post-year-end sales prices for NRV. You're well on your way.
Definitely. And perhaps a final thought to leave you with, circling back to where we started with reasonable assurance. We've seen the auditor relies on judgment, sampling, and client representations to an extent. We provide high, but not absolute assurance. The entire financial reporting system relies on users accepting this inherent limitation that a clean audit opinion signifies professional confidence based on rigorous procedures, but not an infallible guarantee.
A statement of confidence, not certainty.
Precisely. So maybe reflect on how that fundamental boundary accepting that audit risk can be reduced to low, but never zero shapes the auditor's role, public expectations, and the trust placed in the financial information you'll one day be auditing and potentially signing off on. It's a significant responsibility built on a nuanced reality.
A thought-provoking point indeed. Well, that brings us to the end of this deep dive into ACCA Audit and Assurance. Keep practicing those questions, focus on application, and good luck with your preparation. Until next time.